Okay, so welcome to my brief introductory video about audit committees. So here you see a humorous little cartoon about an audit committee. 6 members of the audit committee here are grilling the finance director, the FD. They're saying to him, "We don't want you to view this audit committee as being in any way confrontational." So this kind of illustrates, the role of audit committees. It's to help to protect shareholders against the actions of senior management. If senior management are not acting in the best interest of shareholders, the audit committees are there to act as a corporate governance constraint on managerial behavior. Okay. Let me run through what we're going to talk about in this seminar. First, we'll describe the main functions of an audit committee. I'll cover that in this video, as well as in question number 1. In what sense are audit committee members, internal auditors, and external auditors expected to be independent? And the reason I'm asking that question is that these three are often described as being independent, but the concept of independence is different. So when we talk about audit committee members being independent, that's different from, for example, external auditors being independent. Right? So we'll talk about how the concept of independence is different for these three. Third objective, how does the work of an internal auditor differ from that of an external auditor? And fourthly, list the other board committees and describe their main functions. Okay, in terms of class reading, you need to read through the questions on this seminar outline, and there's also a student presentation to read. And in addition, there'll be a pub quiz about the waste management case, which is covered in question 2. That's just to make sure that students have read through the case. There's the video that I'm producing right now. There's also a video about waste management, which is the case we cover in question 2. It's not compulsory that you watch this video, but it provides some interesting background to what happened at this company. And the video is only 6 minutes long. There's a question about illegal acts by clients. If you don't know what an illegal act is or the auditor's responsibilities with respect to illegal acts, then I recommend you read this auditing standard. And then there are 2 additional standards that you may want to read as well. Okay, AS 1301 talks about communications with audit committees, and then 1305 talks about the auditor's responsibility to communicate internal control deficiencies to the audit committee. Okay, in terms of the questions, question 1 is about the relationship between audit committees, internal auditors, and external auditors. Part A asks, in what sense are they independent? Part B asks, how does the work of an internal auditor differ from that of an external auditor? Part C, in addition to the audit committee, what are the other board committees and what are their functions? And then part D, what are illegal acts and what is the auditor's responsibility if the auditor finds that illegal acts have occurred? So that's question 1. Question 2 is about a company called Waste Management that was involved in an accounting fraud. So here it describes the nature of the fraud, what happened. And this is a corporate governance question. So there's some information here about the corporate governance practices. All the way down here, corporate governance practices at the company. And then the requirement here is for you to identify the corporate governance weaknesses at Waste Management that could have contributed to the fraud taking place. All right, so that's question 2. Then we'll also do some multiple choice questions. And we also have a student presentation about audit committees. Okay, we have several newspaper articles relating to corporate governance issues and audit committee issues. Okay. And so you should find these quite interesting, and they are going to be relevant to the questions that the students are going to discuss in the presentation. Okay, so for example, there's an article here which asks, is corporate governance overrated? So you have the following questions that will be covered in the student presentation. First of all, imagine that you're invited to become an audit committee member for a large publicly traded company what would you need to consider when deciding whether to accept the invitation? So that's the first question. The second question is about the relationship between audit committees and audit firms. So as it says here, primary concern of audit committee members is to reduce their exposure to legal liability. So some critics say that audit committees are biased towards hiring the larger, more reputable and perhaps more expensive audit firms like the Big Four, and ask you to evaluate this comment. And then also, do you think that large audit firms are likely to be biased in favor of choosing clients that have more effective audit committees? The third question is, what issues are raised when a member of the company's audit committee is a former employee of the company's audit firm? And then fourthly, do you agree that corporate governance is overrated and that audit committees are generally ineffective? Okay, so those are the questions for the student presentation. Okay, so we have the learning objectives that I've already talked about. Let me talk to you now a little bit about what an audit committee is. Okay, so as you can see here in the picture on the right, we have a board of directors, 10 directors sitting on the board. And what the audit committee is a subcommittee of the board of directors. So some of these individuals will sit on the audit committee. So if you've got 10 directors on the board, you may have, say, 3 of these people who also sit on the audit committee. In addition to the audit committee, you may have other committees like the nomination committee and the compensation committee. The role of the nomination committee is to nominate the company's directors and senior managers. Right? So for example, if the company is looking for a new CEO, the nomination committee will be responsible for going out and deciding who that CEO is going to be. And you also have a compensation committee, and that's responsible for setting the compensation or the pay of directors and senior managers. Okay. Now, the audit committee is required to be independent of the company's management. Okay, that's important because the audit committee's role is to act as a safeguard, right, to protect the interests of shareholders against managers who may have their own self-interests. Okay, so every member of the audit committee is required to be independent. That is, they can't be a full-time company employee. So for example, the CEO and the CFO of the company are not allowed to sit on the audit committee. Now, audit committees form part of an overall corporate governance framework. Okay, so there's kind of a lot that goes into corporate governance, and audit committees are just one part of that. And audit committees work alongside the internal auditors and external auditors. So let me explain a little bit about how that works. So diagrammatically, I have here the internal auditors, external auditors, the audit committee, which is a subcommittee of the bigger board. And essentially, you've got arrows linking up all 3 of these. So these arrows indicate that there are two-way relationships between each of these 3 individual parties. So for example, when internal auditors report their findings, right, when internal auditors do their operational reviews of different company functions, like, for example, marketing, advertising, production, human resources, right? These internal auditors will assess the efficiency and effectiveness of company operations, and then they will report back to the audit committee, right? So you've got an arrow going in this direction. But then in addition, the audit committee will oversee the work of the internal auditors, right? So if the audit committee, for example, is particularly worried about risks involved in sales, right? Perhaps they're worried about salespeople stealing money or getting kickbacks from customers, then the audit committee will direct the internal auditors to investigate and have a look at that. Okay, similarly, you have a relationship between the audit committee and the external auditors. The audit committee takes oversight of the work of the external auditors, and the audit committee is the one that decides which audit firm to appoint as the company's auditor, and the audit committee will also decide how much the external auditors should be paid, so how much the audit fee should be. And if the company is going to purchase any non-audit services from the external auditor, again, this has to be pre-approved by the audit committee. Okay, so there's a relationship going in this direction. And then in addition, there's a relationship going in the other direction, because the external auditors will need to report to the audit committee about any problems they find, any significant or material internal control weaknesses, and they'll have to be reported to the audit committee. Okay, now in addition, there's also a relationship between the internal and external auditors. So for example, if the internal auditors have already tested the company's internal controls in some particular function, the external auditors may be able to rely on some of that work done by the internal auditors. So the external auditors don't have to reinvent the wheel. They don't have to re-perform the same tests that are done by the internal auditors. But the external auditors need to check that the internal auditors are competent and that they're independent. And what we mean by independent is that the internal auditors report directly to the audit committee. So external auditors can depend on the work done by the internal auditors, as long as the internal auditors are competent and independent. But in addition, there's also the arrow going in the opposite direction, in that the internal auditors will respond to the findings of the external auditors. So for example, if the external auditors note that there are some material weaknesses in internal control, the audit committee may then tell the internal auditors to go about redesigning, repurposing the control system to eliminate those weaknesses. Okay, so the work of the external auditors can also impact on the work in the following year that's done by the internal auditors. So all three of these kind of like interact with each other, right? They all intersect. So what are the main functions of an audit committee? Well, first of all, the audit committee must take responsibility for appointing, remunerating, that is paying, and removing the external auditors. Okay, so we talked about this in the context of SOX in a previous seminar. Right? The audit committee is the one that is responsible for deciding which audit firm will be appointed, and if they're going to change audit firm, it should be the audit committee that makes that decision. Secondly, the audit committee will discuss with the auditor the nature and the scope of the audit. So for example, is there a bank compliance report that needs to be prepared by the auditor that's going to get sent to the company's bank? Does the audit committee want the auditor to do some tests for fraud in any areas, right? So those kind of additional add-on audit services will have to be agreed up front between the audit committee and the audit firm. The audit committee will also discuss problems arising from internal and external audits. That's what I already mentioned on the previous slide, right? So the audit committee has to interact with these two. The audit committee acts as a buffer between the auditors and management, right? So internal auditors are reporting directly to the audit committee, right? So management can't impose their own will on the internal auditors. That helps to maintain the internal auditors' independence. And similarly, between the external auditors and management as well. Right? The audit committee can help protect the independence of the external auditors by having their own dealings with the external audit firm and limiting the amount of contact between the senior management, like the CFO, and the audit firm. Okay, so this is important. This fourth bullet point is relating to the independence of the internal and external auditors. And then fifthly, the audit committee is responsible for reviewing interim and annual financial statements. Of course, the annual financial statements will be audited. The interim statements may be reviewed, or they may be audited by the company's audit firm. Okay, so again, they will be discussing the results of those reviews and audits with the external audit firm. Okay, that's where I'll stop the video for today. In class, we'll go into question 1. Thank you for watching.